Welcome to the Savvy Investor, where it's our job to help you be secure in any economy. You know, the Bush tax cuts expire at the end of this year, and today we're going to talk about the 10 things you really should be thinking about doing before they expire.
Welcome to the Savvy Investor. You can have financial security in any economy. Today is the day you can take control of your financial future and eliminate worry about your retirement forever. Each week, the Savvy Investor helps viewers just like you create and grow wealth, protect and preserve it, and distribute it in the most tax-efficient manner. And now, the Savvy Investor with your host, Michael Canet.
Welcome back to the Savvy Investor. I'm your host, Michael Canet. You know, we've seen in the news over the last year, heck, the whole election cycle was all about the expiration of the Bush-era tax cuts and the fiscal cliff. And I have news for you, viewers. Your taxes are going to go up, or let me phrase this politically correct. Revenue is going to be raised, and that means basically your taxes are going to go up. There's no way for us to pay for everything that we want, everything we expect, and not increase taxes. Now today we're going to talk about 10 things you need to do between now and the end of the year to reduce your tax bite this year and hopefully reduce your tax bite, or at least put yourself in a situation to pay the least amount of taxes legally possible next year. Now I have a whole list. It's a big laundry list. We're going to go through them, try to get through each and every one of them. So with the first one, I just want to talk about here what we're going to be doing. First and foremost, we want to get to question number one. The most important thing you should be doing is when should you realize long-term capital gains? And long-term capital gains really have to do with items that you've owned, investable assets that you've owned for longer than a year. Now, the current rule says that for most of us, we pay 15% tax on things that we sell that we've owned for more than a year. That's stocks, that's bonds, mutual funds, it's real estate, it's limited partnerships, any type of asset that you owned for more than a year. Now the new rules starting in 2013 suggests that you're going to be paying 20%. Well, the 5% increase is pretty significant. I mean, it's a 25% increase in your tax rates because of just that 5% bill. Now, and also keep in mind, one of the things you need to pay attention to is the Obama tax bill for Medicare tax. That's 3.8%. So altogether, for many of you, you could see an 8.5% increase in your taxes just on capital gains alone. So the question is, sit down with your tax advisor, not a tax preparer, but a tax advisor. Sit down with your investment advisor, find out does it make sense to cut out some of your capital gains today. Take some of those winnings off the tables today. And it actually serves two purposes. Even if you don't need to take the winnings off, even if you're not so worried about the capital gains, what you can also do at a lower tax rate today is basically build up that basis. And the basis is the difference is the basis is what you paid for it. And when you sell it, the sell price, the difference between those two is capital gains. You can increase your basis, especially if you have capital loss carry forward. So the number one thing from my perspective is to pay attention to capital gains rates going from 15 to 20%. And we all understand the little Buffett rule here. Warren Buffett pays an incredibly low tax rate because most of his money comes from capital gains. We actually have devised tax strategies for many of our clients where they pay 0% tax on their capital gain sales just by the very nature of how we've structured their income. You get to do that this year. Next year, it goes away. So talk to somebody about should you be harvesting capital gains in 2012 as opposed to 2013. Now, the second thing that you should be doing is taking a look at, do I need to be talking to an estate planning attorney? And the reason why we want to talk to an estate planning attorney, especially between now and the end of the year, is that you get a $1 million exemption to state taxes in 2013. It goes back to the old rules from 2001. Now, we just did a show on this last week with Chester Hobbs. Remember, this year in 2012, you can actually exempt a little over $5 million. That's an incredible increase from what you can do in 2013. And if you think about the tax bill difference, just on between $1 million and $5 million, let's say you're worth $5 million altogether. Your tax bill in 2012, if you have the common courtesy for your heirs to die in 2012, would be zero. You wait till 2013 to die, all of a sudden they're paying 37 to 55% tax on $4 million. you better hope the heir who's inheriting that extra $4 million is not the person who controls your advanced care directive and living will, because they will pull the plug in 2012 to save $2 million in taxes. That's a huge tax bite for failing to take care of estate tax planning rules in 2012. You have a very, very narrow window to get this done. All right, so what's the next thing we should do? Number 3, the most important thing that you should be talking to your advisors with. Again, I just want to take a moment. When I say advisors, people often misunderstand what an advisor is. From my perspective, there's a big difference between a tax planner and a tax advisor. A tax planner is one of those places that are open 3 months out of the year, and all they do is prepare your taxes. They put numbers on a page. They do not give you advice on a regular basis to how to reduce or structure your investments or your assets to pay the least amount of taxes possible. That's what a tax planner does. So you need to be talking to a tax planner. Now, as far as an investment planner versus an investment salesperson is great about telling you here's a stock or bond to buy or a mutual fund. But when you ask them what are the tax implications or estate planning implications, if they say, sorry, that's not my job, you need to talk to an estate planning attorney or a tax planner, you know that person is just a salesman, he's not a planner, and that's not the person you should be having these conversations with that we're talking about today. Now we're going to take a quick break here. When we come back, we're going to get through the next 7 things that you really should be planning for between now and the end of the year. You're watching The Savvy Investor with your host, Michael Canet, and we'll be right back.
Join the host of the nationally syndicated TV series The Savvy Investor and best-selling author Michael Canet for this very important, life-changing workshop. Michael and his team of advisors from across the country have been helping families create and live the retirement they envision by carefully crafting a retirement income plan that can withstand any financial crisis. Michael will give you the tools you need to make sound investment choices and help you prepare for your golden years. At this workshop, you'll learn more than just where to invest your money. Michael will also share tax strategies that could save you and your family thousands in tax dollars. You'll learn important estate planning techniques that can help you avoid the high cost of a nursing home, as well as reduce or completely eliminate any estate tax. Now you can join him in person for these very informative workshops. They could be the answer to creating the safe and secure retirement you deserve. Call 866-597-1040 to see if you qualify to attend one of these workshops with best-selling author Michael Canet, host of The Savvy Investor. Seating is limited, so call 866-597-1040 to join us.
Welcome back to The Savvy Investor. I'm your host, Michael Canet. When we left for a break, we had discussed three things that you should be thinking about doing between now and the end of the year to protect or minimize taxes to the extent possible. We talked about recognizing capital gains. Should you be doing it in 2012 versus 13? And we've discovered that taxes are going to go up by about 25% if you don't recognize those gains today. We talked about harvesting gains today and offsetting them against losses to reduce your overall taxable gains in the future. And then we talked about the idea of estate tax and whether it made sense to do some tax planning today, because you can give away $5 million. You can plan and protect $5 million today, but in 2013, you can only protect $1 million. So we've covered 3. We have several more to go through. The next thing, and we get this in our office all the time, should I convert from a traditional IRA to a Roth? Well, certainly if you're going to convert and you're going to end up paying taxes on it, you want to convert in 2012 versus 2013. Now, there are some really cool strategies that we employ for our clients where we can show them how to convert, basically not pay any tax. I'm talking about doing it in such a fashion that we can get away with paying 0 taxes converting from an IRA to a Roth. Now, it takes certain strategies to make it happen, but when you work with a planner instead of a preparer, there are some really cool ideas that come to play. But so here's the bottom line for me. Should you have a Roth IRA versus a traditional IRA? If you want to convert from a traditional to a Roth, it means you have to pay the tax. In order to get the money from one side to the other, you have to pay the taxes on it. If you're going to use the money from that Roth IRA in the next 7 to 10 years, basically within 7 to 10 years of you converting, it's probably not a good idea because you can't recoup the tax cost. It takes too long. 7 to 10 years is a good rule of thumb. If you're thinking about leaving this money for your heirs, that the reason why you're converting to a Roth is to pass it on to your heirs, I hate the idea of converting to a Roth because you pay a boatload of taxes up front to give your kids a tax-free benefit, which is wonderful, but it's still subject to estate tax. I think there's better solutions out there than converting to a Roth. Now that's number 4. Let's get on to number 5. When should you receive income? If you work for an employer, like my good friend George, maybe you can plan on your income. Sometimes you can bill your clients in 2012, and sometimes you can bill them in 2013. Now, in my particular situation, because I do some work with him, I would really prefer him to bill me in 2013 because that's better for me. But the fact is, for George, he'd be better off billing me more in 2012 and not billing me in 2013 because he'll pay lower taxes in 2012 than he will in 2013. So if you have an employer arrangement, maybe if you're getting bonuses or stock options or any of those type of things, you might talk to your employers about getting them paid in 2012 instead of 2013 to save you a little bit of tax money. Now that's 5. Before we go on to the next 5, I want to do a little bit of viewer mail like we do here every week on the Savvy Investor.
You've got mail.
Now we all recognize that retirement planning is daunting, it's scary, it's overwhelming. Email us at thesavvyinvestor@primefs.com. We answer questions here every week, but even if I don't get to your questions on the air, we will respond to you. thesavvyinvestor@primefs.com. Now we have a couple different things here. First and foremost, who do we have here? We have Stephanie from Bethesda, and Stephanie says her mom is subject to RMDs. Those are required minimum distributions. Stephanie's mom is over 70 and a half, evidently, and her advisor suggests that her mother convert the IRA over into a Roth and avoid RMDs in the future. Well, Stephanie, that's exactly what we were just talking about. If mom is taking money at 70 and a half, now what happens is the federal government, IRS, has set up this kind of stealthy plan. They convinced you that it's a really good idea to put money into IRAs for a long time. Well, when you're accumulating wealth, IRAs are a great tool to accumulate it because it's all tax deferred. The problem is you have a silent partner the whole time you're accumulating, and that's what Stephanie's mother is running into now. The IRS wants their share of your money, and they want you to take money out of that IRA each and every year. Now, once you reach 70 and a half, you're forced to take distributions. Well, Stephanie, if your mom doesn't need the money, converting to a Roth IRA might make sense. She pays a little bit more tax up front today, but it avoids RMDs and any withdrawal requirements, not only for her, but when she passes away, the money comes to you tax-free. Now, you're forced to take required distributions, but they're still tax-free even when you inherit the money. So converting to the Roth, if she doesn't need it, may make sense. Although, like I said, I think there's better solutions, and when you sit down with a tax planner and a financial planner, they can give you some ideas of some alternatives. Rather than paying that big tax bill today to convert to a Roth IRA, it might make sense to use life insurance. Pay a little bit as you go, keeps you in a lower tax bracket along the way, and it's estate tax and income tax free when handled properly. But that's a great question, Stephanie. Now we also have an email from Orlando in Orlando, Florida. Is that right, folks? Orlando, that's funny. All right, yep, George is saying that's right. Okay, so my sister lives in Philly and is retiring from the federal government, and he suggested to her that she move to Florida because they don't have state taxes, but she said that Pennsylvania doesn't tax their federal pensions either. Is that correct? And Orlando, yes, the answer is correct, that if she stays in Pennsylvania, her federal pension is not taxed at the state level. Now, the rest of her income is taxed there, so if she has investments, dividends, interest, all the rest of her income is taxed there, but unlike Florida, where none of your income is taxed. So, for family reasons, it makes sense to move to Florida, but from a tax perspective, unless she has a lot of income related to dividends and interest and capital gains, Pennsylvania has a pretty reasonable tax at the state level. Now, what they don't collect at the state level, and Orlando, you're aware of this, what they don't collect at the state level, they figure out a way to get you someplace else, be it local taxes, property taxes, school taxes. And Orlando, your sister outside of Philly has every imaginable tax out there. She gets to save taxes on the federal, but they figure out how to gouge her someplace else. So the answer in short is yes, she does get a discount and not have to pay taxes on her federal, but they make it up someplace else, just like they do in Florida. But great questions. All right, you know what? I think we're going to take a quick break here. When we come back, we'll continue our conversation on the 10 things that you should be doing between now and the end of the year to save taxes. Now, we've talked about 5. When we come back, we have 5 more ideas for you that you should be implementing between now and the end of the year to reduce and or eliminate taxes this year and to minimize taxes going into the future. You're watching The Savvy Investor with your host, Michael Kinnett, and we'll be right back.
Remember when life was simpler? When things didn't move quite so fast and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, more and more uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and proven solutions for the road ahead. From investments and insurance to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive, we're your single point of contact, a single call, a voice you recognize well, and a partner who will be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
Now keep in mind that just like any tool, there's the right tool for the right job and a wrong tool for the wrong job. We have just scratched the surface here, and you'll want to know more about how today's conversation might or might not fit your needs. Ask about fees, surrender charges, market risk, interest rate risks, how the guarantees work, liquidity, and much more. Remember, the right tool for the right job.
Welcome back to The Savvy Investor. I'm your host, Michael Kinnett. Today we're talking about the 10 most important things you should be talking to your financial advisor or tax planner about between now and the end of the year. We have the expiration of the Bush-era tax cuts, and your taxes are going to go up if you don't plan accordingly. So we've covered 5 of them. Now let's get to the next 5. Number 6, are charitable contributions more valuable in later years? Now for those of you who itemize, the whole idea of having charitable deductions means you get to reduce your taxable income, right? You get to reduce your taxable income by the amount of money that you contribute to charity. Now, we all know that the IRS has gotten much tighter about their rules on what qualifies and what record keeping you have. So putting that aside for a moment, the answer is yes. If you can figure out a way to maybe front load so that you're, or back load rather, so you're putting donations, instead of doing them in November, December 2012, and I know people do charitable donations for various reasons, and certainly over the holidays, charities ask for more, and it's more noticeable, and people are a little bit more of giving nature over the holiday season. But nevertheless, if you push those donations into January, you might be able to save a little bit more money on your taxes. And again, I recognize we don't always do it for the tax deduction, but nevertheless, if that is part of the motivation, the reward is personal, but the tax motivation is there for saving taxes. Think about pushing them into January. It still helps the charity, but you save a bundle in taxes, especially if your taxes are going to go up by 25 or 30%. Think about that. That's an extra 25 to 30% reduction in your taxes because you push it into 13 instead of doing it in 2012. Now, number 7, should you time your itemized deduction? That goes kind of hand in hand with what we just talked about with the charitable deductions. And the answer is yes. Again, there are several things that you can do that instead of paying in 2012, push forward into 2013. For example, your property taxes. You could push property taxes and state and local tax payments and pay more of them in 1 year. Get them all into 2013 instead of 2012. Now, the common rule of thumb was always to pay your 4th quarter 2012 state taxes in 2012 because it reduced your taxes in 2012. Well, what happens if you put it in 2013? That's an extra deduction in 2013, and the normal deduction that you would do in the 4th quarter, which is January of 2013, do that in December 2012, and now you have an extra deduction in 2013 that will further reduce your taxes. I know it sounds complicated, but if you talk to your tax planner, it actually does work. Same thing with out-of-pocket medical expenses. Prepay medical expenses in 2013. Push them off into 2013, but before you get to the end of 2013, prepay 2014 stuff. That could be healthcare costs, that could be premiums. There's all sorts of things related to healthcare that you can prepay. And again, you're trying to bundle up more and more. So maybe in 2014 you might not have as much, but if we can bundle more in 2013, it saves us a bundle in 2013. What else can we do? Well, number 8, the whole idea, a lot of us have put away money for our kids for college and the whole 529 and education accounts. When should you be taking it out? Is it better to take it out in 2012? Is it better to take it out in 2013? Well, fortunately for us, the taking out part isn't the question, because those are tax-free withdrawals as long as they're used for qualified expenses. But remember, in Maryland and most states, when you enter into a state-sponsored plan, there's a tax deduction for you. So are you better off having the tax deduction at 12, or are you better off having the tax deduction at 13? I think if you overload 13, you're better off because you're going to save money. Now remember, we know that at least in Maryland, it's $2,500 per account per person. So between a husband and wife, if you have one kid, you can put $5,000 away. Well, maybe you want to, if you can't normally afford $5,000, maybe you can only afford $2,500. Here's a chance where you, instead of putting your payments in December for the end of the year, maybe you just wait till January, you do it in January. Maybe get family and stuff putting money into it. But the idea here again is to bundle the 529 contributions into 1 year. If you have to bundle 12 into 13 and 14 into 13, that's a great opportunity to save some taxes. Now, obviously, if you're doing the maximum anyways, it doesn't matter. But if you're not maxing out on the 529, there's a way to reduce your taxes. Now, number 9, this is a really complicated thing, and I'm only going to take a moment with it, but it has to do with exercising employer stock options. These are options that employers give to key personnel and key employees as an incentive to keep them around, to not leave, to pay them a little bit extra without actually having to put money onto the W-2. It may make sense to sit down with a planner and figure out, should I recognize them in 2012, which again, income we're trying to recognize in 2012, but expenses we're trying to push off into 2013. So it may make sense to sit down and talk to a planner about recognizing some of those options in 12 when the capital gains rate and the tax rates are going to be lower than waiting to 13. And I can't stress this enough. Remember, there is the Obamacare tax bill that's going to be due in 2013. For single people over $200,000 and for married couples over $250,000, you could wind up paying an extra 3.5% for a total of 8.5% more just on capital gains. Your income taxes, those could go up depending on what Tweedledee and Tweedledum, which are the Republicans and Democrats, if you've been listening to me. It depends on what they come up with for the fiscal cliff. You could be in the next tax bracket, it could be as high as 40% and plus by the time these clowns get done with us. So think about sitting down with a planner in 2012 to figure out the employee stock purchase or the employee stock option plans. And I think the last thing, and I alluded to this earlier, the IRS commissioner doesn't do his own taxes. Now you think about this. The guy in charge of the IRS is smart enough, well, he did take a job with the IRS, but nonetheless, he is smart enough to recognize that he should not do his own taxes. I don't do my own taxes. I think if the IRS is telling you that their top dog, the person in charge of the IRS, doesn't do their own taxes, you should probably think about hiring somebody to do your taxes as well. And I talked about the difference between a tax preparer and a tax planner, and I want to go back to that again for just a minute. Do not pay somebody to just put numbers on a page. You don't need to pay for typing skills. You want to pay for somebody that has knowledge, that has true understanding of how these tax codes work, but also how to maximize the benefits. Remember, we all have a legal obligation to pay our taxes, absolutely. But we also have the opportunity to pay the least amount of taxes possible. And that's what you get when you work with a true planner, somebody who will sit down with you several times a year and talk to you about how to reduce your tax bill. Again, don't pay for typing skills. I mean, that's a high school education. Pay for somebody who truly understands how taxes work and how to reduce them. Now we're going to take a break. When we come back, we're going to finish up our conversation about taxes and the expiration of the Bush-era tax cuts. You're watching The Savvy Investor with your host, Michael Canet, and we'll be right back.
Join the host of the nationally syndicated TV series The Savvy Investor and best-selling author Michael Kinnett for this very important life-changing workshop. Michael and his team of advisors from across the country have been helping families create and live the retirement they envision by carefully crafting a retirement income plan that can withstand any financial crisis. Michael will give you the tools you need to make sound investment choices and help you prepare for your golden years. At this workshop, you'll learn more than just where to invest your money. Michael will also share tax strategies that could save you and your family thousands in tax dollars. You'll learn important estate planning techniques that can help you avoid the high cost of a nursing home, as well as reduce or completely eliminate any estate tax. Now you can join him in person for these very informative workshops. They could be the answer to creating the safe and secure retirement you deserve. Call 866-597-1040 to see if you qualify to attend one of these workshops with best-selling author Michael Kinnett, host of The Savvy Investor. Seating is limited, so call 866-597-1040 to join us.
Remember when life was simpler? When things didn't move quite so fast and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated, more and more uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and proven solutions for the road ahead. From investments and insurance to tax reduction strategies, estate planning solutions, and guaranteed retirement income you cannot outlive, we're your single point of contact. A single call, a voice you recognize well, and a partner who will be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. For a special free guide entitled 10 Things to Know About Retirement Income, simply contact us today.
If you're in retirement or retiring in the next 3 to 5 years, you must read Michael Kinnett's best-selling book, Surviving the Perfect Storm. Best-selling author and National Quill Award winner Michael Kinnett's Surviving the Perfect Storm is a must-read to prepare for your golden years. This amazing book can be yours absolutely free, but you must call 866-597-1040 now. Supplies are limited, so be one of the first 25 callers to receive your free limited edition autographed copy of Surviving the Perfect Storm. Call 866-597-1040 now.
Welcome back to The Savvy Investor. Today we talked about the 10 most important things you can be doing between now and the end of the year with the expiration of the Bush-era tax cuts upon us. Now sit down with your tax planner, sit down with your investment planner, because there's certain things you need to be thinking about between now and December 31st to help you pay the least amount of taxes legally possible. We'll see you, The Savvy Investor, next week. If you'd like more information about today's show, you can contact our offices with our toll-free number, 866-597-1040, or visit us on the web at www.thesavvyinvestortv.com. When you visit our website, sign up for our free weekly newsletter where we give you tidbits each week to help you make smart money choices. Every retiree's goal, from our perspective, is to take the least amount of risk possible to accomplish your goals. Too often, financial advisors and stockbrokers assess your risk tolerance. Just because you can tolerate the risk doesn't mean you have to accept it. Remember, at the end of the day, it isn't how much you make, it's how much you keep.